I want to bring in Anthony Chan. He is chief economist at JPMorgan. Talk a little about the economy and the backdrop for stocks. Anthony, you say we shouldn't be concerned about a correction at this point.
Absolutely not. In fact, in the first year of a presidential term, which is an 8-year term, you certainly don't get a lot of correction. Only 4% of all the market corrections we've gotten since 1946 occur in the first year of that term.
Wow.
And if you look at bear markets, because some people will say, oh, but what about bear markets? We've had 13 bear markets since the 1940s. Only one bear market, or 8% of the bear markets, occur in the first year. And by the way, a lot of people say, but look at the recessions. More than 60% of all the recessions occur in the first term of a presidential term. But guess what? This is unusual. We're going to have fiscal policy in a world where we have a 4.6 unemployment rate. So this means that the probability of a recession is much lower, and the equity market is going to do a little bit better.
Actually, Steve Mnuchin told us that he's looking for 3.5% to 4% economic growth next couple of years. You think it's doable?
That's a little aggressive. I don't think we can get 3.5 to 4. Some of that was talked about in the campaign trail. I was more excited that now they've toned it down to 3 to 4%. Even that is a little aggressive, but 2 to 3%, absolutely doable. And when you get rid of federal regulations, 70% of them, I'm not going to make a judgment as to whether they're good regulations or bad, but if you get rid of them, it lowers the cost. You lower regulations, again, I won't make judgment whether it's a good thing or not. It lowers the cost of financial institutions. Profits go up. In fact, we've done some estimates that show that if you lower the corporate tax from 35% to 15%, as has been promised, it will raise S&P 500 earnings over a 12-month period between 19 and 20%. And even if you go down to 20%, it will raise S&P 500
over a 12-month period.
Over a 12-month period between 10 and 11% above whatever the consensus is. Right now, the consensus for next year is 12.3% for the S&P 500.
Wow.
Now, granted, all this is not going to take into happen next year.
Is this shaping up as a better period for the markets than for workers? Because it seems that the Fed isn't going to let the economy grow 4% a year because they don't want to see inflation get out of control. The unemployment rate is already at 4.6%. But so they lower tax rates, that helps companies, but is it really going to help the American worker?
Well, I think we're already starting to see the American worker benefiting a little bit. Wages are rising at 2.5% year over year. And in fact, if you look at the Atlanta Fed median wage tracker, it's above that. It's above 3%. So it's getting better. But there's no question that right now, with productivity being very sluggish, this is not the best time for workers. Workers really have to scramble to improve their labor skills in order to improve their standing.
I don't look at it. I also look at it from the point of like an entrepreneur, somebody who wants to go out there and chase a dream and build a business and start a business, rather than it, you know, hey, are my wages going to go up? Is my employer going to treat me better than I'm getting treated right now? It's really about opportunity. So that goes right to that goes right to optimism in this country.
Well, that's one of the reasons why consumer confidence just hit one of the highest readings that we've seen in this economic expansion. So there is excitement. You call it animal spirits, call it excitement with the change that's taking place, or excitement because now it's going to be a little easier for corporations to make a lot more money. This is actually generating the excitement that you're seeing in the equity market. And by the way, most of middle America and even low-income individuals that have any kind of a 401k plan in their job are going to benefit from this improvement in the labor. The S&P 500 is up 10%.
I always argue that because people on the left, as the market rallies, they go, the average person isn't participating in this rally. I'm like, the hell, they're not participating in this rally. And they do pay attention to it. They do look at their 401k balance.
And they do, and they should. 10% up year to date for the S&P 500, including dividends so far this year. That's very impressive in a world where we've been complaining that corporate profits haven't been very strong, but now that's an anticipation of what's likely to happen over the next several years.
What about technology stocks? They have not performed well in this rally. And by the way, I want to tell my Twitter followers, you just said that cutting the corporate tax from 35 to 15% will boost S&P 500 earnings by 20%?
Between 19 and 20% over a 12-month period, once that's instituted, yes.
Okay, so what about technology?
Technology, well, there's a couple of other things. Taxes are going to be coming down, and technology has one of the lowest effective corporate taxes. So they benefit a little bit less, but they still will benefit. And then on top of that, more than 50% of the revenues of the technology sector come from overseas. And guess what we've been seeing? Earlier this year, the dollar was actually weakening, if you look at the DXY. Now it's appreciating again. So that's another bit of a headwind for the technology industry. Wow. So which sectors are benefiting? The sectors that have the highest effective corporate tax rate. The energy sector has the highest effective corporate tax rate of all the S&P 500 sectors. That's one of the reasons why the energy sector is benefiting from in this rally.
I love it. Now, that's a way to wake up in the morning. Thank you, Anthony. That's all good news.
Well said.
We appreciate it. Anthony Chan joining us, JPMorgan.